our panelists, starting with Ashley Johnson, the Chief Financial Officer, Chief Operating Officer of Wealthfront. We have Ryan Williams, the CEO of Cadre. We have David Klein, the CEO and co-founder of CommonBond, and Michael Weisz, the president and co-founder of YieldStreet. So normally, this is a hedge fund conference, but I've noticed that there's a mixed crowd this year. We have more folks from Silicon Valley than ever before, but we still have that deep Wall Street presence. So let's start off. Why should folks in this room care about what you all are doing? Ashley, let's start with you.
Sure. So Wellfront is here to reestablish trust between consumers and financial services. We have reinvented how investing services are delivered, and more recently, we've reinvented how banking services are delivered. We launched a cash account that offers 2.29% interest, which is 20 times roughly what banks are offering their consumers today, and $1 million of FDIC insurance, which is 4 times what they are offering. And we're doing all of this the way millennials want to receive their services, which is all through mobile applications. There are no branches. There's no inconvenient in-person meetings. This is all done in a highly personalized but low-cost and convenient way, which is what the market currently demands.
Ryan?
So I'm the CEO and co-founder of Cadre. And Cadre is building the preeminent global exchange for alternative assets. We're focused first and foremost on commercial real estate. And what we're looking to do is actually somewhat straightforward. We want to allow more individuals direct access to liquid real estate. We're building a platform that connects investors, primarily accredited family office and some institutions, directly to institutional-grade commercial real estate deals that have historically been out of reach for the vast majority of individual investors. So access is a key part of what our platform provides and focuses on. The second key platform to what we're doing, key component to what we're doing rather, is liquidity. Real estate, like a lot of alternative assets, has historically been illiquid. We recently launched the first direct secondary market for commercial real estate, closed dozens of trades, sometimes within minutes. And it's a part of a paradigm shift that we believe will happen in real estate and other alts, where direct, transparent access and liquidity become the norm, not the exception. We've created an incredible team with folks from the Blackstone, Goldman, Starwoods of the world, as well as engineers, data scientists from the Facebook, Google, Squares of the world. And that combination is what's allowed us to really position ourselves and establish a market-leading position in real estate. But the future is alternatives, and the future is making alternatives less alternative.
Hi, everybody. At CommonBond, we are looking to make higher education more affordable, more transparent, and student debt more manageable. So at CommonBond, we like to say if you have student loans or need student loans, we can help. And we do that in 3 primary ways. First, if you're going to school and you need a low-cost student loan, we offer that. Once you've gone to school and you've graduated and you're holding student debt and you want to refinance that debt into a lower rate product, we can help. And if you are now gainfully employed at an employer, we can help through a suite of student loan benefits that we've created in the form of SaaS technology that we sell into companies and offer to their employees. A couple quick hits on us. We've done about $3 billion in student loans to date. On the enterprise side, we have a little over 300 corporate clients. We are active participants in the capital markets. We've done close to 10 securitizations now, about $2 billion in total. And defaults on our platform are considered to be industry best.
Hi, I'm the founder and president of YieldStreet. And YieldStreet is working on building the largest global digital wealth management platform in the world. And the reason we're doing that is because we believe that access to and distribution of institutional quality investments has been fundamentally broken. So at YieldStreet, we're passionate about this because, on the one hand, we're true capitalists. On the other hand, we believe in financial equality. And what I mean by that isn't that we should be handing out checks to everybody, but we feel that given where technology, regulation, and data are today, you're able to distribute investment opportunities to the masses. And therefore, it shouldn't matter if somebody wants to invest $5,000, $500,000, $5 million, or $50 million. We should leverage the masses to create equality amongst that group. So when we think about doing that and building the wealth management platform of tomorrow, we think about it and we think about our key differentiators are really broken down tactically into 3 areas. One is on leadership. So myself and my co-founder come from 2 completely different backgrounds. My partner, Milind, is a serial tech entrepreneur. His last business he co-founded was Yodel, all about really performance marketing, tech, and ops. Mine is mostly in specialty finance and alternative finance. So the reason that's important is because it drives a culture into our business where the company and the team really feels a sense of how important technology is, and technology is really the driving force behind creating efficiencies and rapid scalability. Whereas at the same time, we drive into the team the importance of asset quality and understanding at the end of the day who our consumer is and who our community is, and why we have to be so careful about what we distribute. Number 2 is we believe that platforms win. And in that vein, YieldStreet offers individuals the opportunity to invest across a wide spectrum of asset classes, because ultimately nobody puts all their capital into one asset class or one risk or one return profile. So we offer asset classes like commercial real estate bridge loans, fine art finance, marine finance, litigation finance, commercial loans, small business lending. Effectively, we're disrupting the credit market. And we think that the broader credit market and our TAM is really $30 trillion. So 2 quick highlights is we acquired a business for about $170 million off of Carlyle in the fine art business. The fine art business has never been an investment available to retail. 2 weeks ago, we sold our first deal of $13.7 million in 31 seconds. Second thing is we have a warehouse facility with our institutional partner. And we feel that if in fact we're true to ourselves about distributing institutional risk, why not make that same warehouse facility available to our consumers, our retail? Yesterday, we sold a 6% 180-day deal in 1 minute. So what we really think is leveraging the masses can enable us to really disintermediate the financial services industry as it's been known to be.
All right, so let's dig in on this. You all are going after what's traditionally been Wall Street's business, disintermediation. Let's talk about the things that are holding you back as a business from growing. David, I want to start with you. What are the challenges?
You know, I think one of the things that traditional large financial institutions have over fintechs in general is the cost of capital and the availability of capital. I think if we had the cost of capital and availability of capital of large financial institutions, we could do a lot with that. Because I think what we do really well is we engage customers, we're able to acquire them for low cost, and we're able to build modern, agile technology that allows us to simplify experience for customers downstream and allows us to run much faster than anybody else's companies. In the broader scheme of things, when we think about Wall Street versus fintech, there's historically, at least the narrative has been very us versus them. I happen to think there's a lot of opportunity to take the best of both worlds, put them together, and provide what's best for the consumer. So take that capital advantage that large financial institutions have, take even the distribution advantage they have with access to millions and millions of customers overnight, pair that up with our ability to acquire high-value customers at low cost, as well as our technology allows us to run fast, you can improve a lot for the consumer.
What do you think, Ryan? You working with Wall Street?
Yeah, we are taking a partnership approach. And I think it's actually a really important point for everybody up here. I think there's a lot of really exciting ideas in FinTech, because financial services in many ways is still relationship driven. There's still a lot of asymmetry of information and access. And That's exciting because many business models will work or do work at a certain scale. But the winners will be the ones who are able to create distribution and partnerships, and oftentimes distribution through partnerships. And so what we've been focused on the first few years was really build an incredible brand, create a level of trust and credibility. Goldman Sachs committed more than $250 million from their private wealth network to invest in their own portfolio on our platform. And we've been able to really, again, establish that position. So now the question is, how do we replicate the Goldman partnerships? How do we replicate the dozens of RIAs that now want to invest through our platform? How do we replicate, the hundreds of operating partners that have brought deals to us? And the answer is we build a best-in-class partnerships, almost B2B team to execute. So our challenge right now is actually not demand or supply, it's human capital and the bandwidth to basically structure these B2B partnerships where you have to have created the trust and the credibility to get a big institution to really buy into something more innovative. And you need boots on the ground and people as well to help that. So that's kind of the point we're at right now that we'd really need to address to accelerate realization of our mission.
Michael, do you also agree that the challenge is human capital, looking for talent? How do you find talent?
It's a great question. I think our challenges are a little bit different. I think as a scaling business, as a rapidly scaling business, all of us are going to have a challenge finding the right talent quickly. I think for YieldStreet, there are two other challenges that are a little bit more at the forefront. Our demand side is incredible, right? So we have a 70% reinvestment rate, over 80% lockout rate. So right now on the supply side of YieldStreet, we're constantly hiring top-tier talent, more management roles, bringing on more people, trying to do more partnerships. But imagine if we had, Ryan mentioned like a Goldman Sachs, right? So think of a Goldman Sachs or another organization of that size that has so much product to distribute. If they had access to the efficiency that we have through our technology to distribute and the demand side that we have, they wouldn't have to send people raising capital. They can put it up on our platform and it would go. So that's one side. I think the other side that I know we face is on the regulation front. So regulation is important. It's critical to our industry. But at the same time, we're doing things differently. We're doing things quicker. The way we distribute, the transparency, the available information is different than it was 20, 30 years ago when a lot of these laws were created. So I think that we need to find a way to be more proactive with the regulatory bodies, to have the discussion more, to think about innovating around that, to make it easier to deliver our product to the market.
It seems like maybe a challenge for Wealthfront would be customer acquisition, bringing on new customers. Can you talk to us, what is the ideal customer profile for you, and how do you compete with the others in the space, including the more traditional Wall Street firms?
It's a very good question. So our target demographic is in their mid-30s typically in their households. So these are the people who are good savers. They have amassed some amount of wealth, but not enough wealth to actually be treated well by the traditional Wall Street players. So they're charged high fees for their investment advice. They might see account maintenance fees from their banks because they're not hitting minimum balance thresholds on a regular basis. Those are the ideal customers for us because we offer the service that they're looking for in a low-cost way. We deliver it the way that they want to. Our challenge is reaching them because the banks and the financial advisors charge 4 times what we're charging for the investment advice and charge ACH bounce fees and minimum account fees and wire transfer fees and all those fees that frustrate you every time you get your statement and see that you've been charged a fee you had no idea to expect. All of those mean the lifetime value of a customer in the short term for a bank is much higher than ours. And so they can pay a lot more for paid marketing to get the name out there and to acquire that customer. We have to be much more disciplined. And so we are very disciplined in how we acquire our customers. We do very little paid marketing, almost no brand marketing. And we rely on word of mouth, a great, delightful client experience. The low fees, the tax efficiency, and the high quality of service means that our clients refer us to their friends, to their families, to the people that they meet in the street. What's exciting is when you're randomly walking down the street as a Wealthfront employee, you'll often hear people talking about Wealthfront and the service that they get and how delighted they are. And that's how we get 75% of our clients.
David, you also run a FinTech company that is consumer-facing as well. We have two that work with investors, but how do you think about the customers, the challenge there, competing against some of the incumbents?
Yeah, I think the challenge for consumers is just how do you get their attention? That, at the end of the day, is the biggest competition I feel like we all have. Yes, we can think about competition in terms of who we compete with as a company, but the truth is, who do we compete with for our consumers' time and attention? And so we think a lot about, as we develop product, we think a lot in the product experience, we think a lot about what's going to capture somebody's attention relative to anything else they could be doing at any given point in time. And so that runs deep in our ethos, that runs deep in our philosophy, and it runs deep in how we build product. That's where it starts. The second layer is, okay, very tactically, what channels are you going to go after? And there, we're in the usual suspects like many others, but we've explored other opportunities that our competitors aren't really in. One of them happens to be partnerships. So on the consumer-facing side, we have signed a number of strategic partnerships with large financial institutions, banks, insurance companies, even very large credit unions, very large FinTechs. And we're noticing that that's a really effective and exclusive way to acquire companies. The third and final piece, I'd say, and to echo one of Ashley's points, is being very disciplined about how we spend our money so that at the end of the day, we can show ourselves and our board that we're acquiring customers for a fraction of the cost of anybody else in the space.
And for Ryan and Michael, what kind of customer do you all attract, and what does that person look like? What's the profile of that person, and who is that ideal customer?
We made a very, very, very concerted effort out the gate to focus really at the top end of the market. So both demand investors and then supply operators. So what does that mean? In practice, it means we were going after family offices, institutional investors, pensions, foundations, endowments. On the deal side, we were going after institutional operators and sponsors that otherwise would partner with the Blackstones or Starwoods of the world. And the reason we made that decision was because we felt it was critical to create a level of trust, credibility, and track record. And by doing that, we would have the optionality to go down market, as well as give ourselves the time and the bandwidth to create the infrastructure to support investing at scale. And so the first few years, we probably took the most challenging path possible, but we were successful in it. I mentioned the Goldman partnership. We've raised hundreds of millions from other institutional investors, many who otherwise would allocate to some of the preeminent real estate private equity firms. And what it's resulted in is an accelerated degree of trust with accredited investors, who are now one of our main targets, and over time, retail investors. So we're really proud of that path. And on the deal side, so the investment products that we allow our investors to invest in, less than 2% conversion. We are nearing $3 billion in AUM on the platform. We approve about 2% of the deals that we see on an annual basis. We've had one realization where we returned almost 2x the capital. And that's resulted in emerging operators and sponsors now hearing about Cadre and wanting to leverage our platform because there's that signal from a trust perspective. So we're focusing on now accredited individual investors on the demand side and emerging operators within reason on the supply side.
Michael?
So at YieldStreet, our primary target demographic since inception has been the accredited investor world. We felt that the average accredited investor, there's roughly 14 million accredited investors that represent $30 trillion of investable cash in the US alone. And those are the primary people that don't really have access. They don't have access to the top market private wealth solutions, but they have cash and they're interested in investing. But when we think about our brand, we think about it completely differently. We don't identify as a financial services business. We really identify as a consumer brand. And what we're trying to strive for and what's worked for us very well is this concept of attainable aspiration. So if you pay attention to the last 20, 30 years of financial services marketing, it's mostly centered around telling people that you need special advice, you need us from the banks, you need wealth management, you can't do it on your own, it's too complex for you, you're not smart enough, this is not your expertise. We feel that today, given the way we can present information, we can inform people that we can take what would otherwise appear to be complex and make it consumable information. So think through the experience that a user has on our platform. They see an advertisement online, they click it, they read up about YieldStreet, they find it intriguing, they read the Learn section, which is all about education, they decide to sign up, they see an investment opportunity come available, they spend a little time looking at it, if they have questions they ask, if they feel confident about the investment when it opens, they make that investment, and then the next month or the next quarter, whenever that interest payment comes in, they see that money in their account. And most of us are used to seeing one deposit, which is our paycheck, our direct deposit, and everything else is outbound. So the experience is euphoric. They feel like they're empowered, they made a decision, it was a knowledge-based investment, and now look at the reward that I can do. All that I've been told all these years is not true. Of course I can do it myself. So we're taking a little bit of a different approach as to how we reach our demographic. I'm excited that in the next couple of weeks we're actually going to open a product for non-accredited investors only to be true to our mission of prosperity for all.
Yeah, and just to add, because he made a really good point related to education and insights. And all of our businesses, I think, respectively, have focused on investing in that area as well. In some cases, it's actually a good thing for folks not to be able to invest in any of our platforms. And I say that because in some ways you don't want an uninformed customer, client, or otherwise navigating something that's really critical to their financial futures without the ability to have that information ecosystem, those insights, that learning. And so there is this really, really exciting opportunity within FinTech to both democratize access and enable people to have better product distribution, but also to democratize insight, to allow more people to really have the opportunities that have been reserved for a very small percentage of our global economy.
Absolutely, democratizing it. I do have to ask you guys this because you all are all relatively new. You're going up against these incumbents. So my question is, what is your moat? What is stopping Wall Street from just crushing you guys and just copying what you're doing and taking all of your customers?
So we exist with the classic innovator's dilemma, where for the large financial institutions to move to an automated service at a very low fee. We offer our investment management service at 25 basis points, whereas most firms are having to charge a point to a point and a half because that's the only way they can make it economic with a human advised service. And so frankly, to even offer a comparable service is threatening to an existing revenue stream that supports a very large expense base, supports branches, supports humans. And so, frankly, it's that dilemma that enables us to move quickly and continue to develop services that'll just make it harder and harder for them to catch up. Because for them to make that investment decision from the top is a very challenging decision given the implications for the rest of the business.
Yeah, it's something that, as you can imagine, when you're hiring somebody who's been at a Goldman Sachs or Morgan Stanley for 20 years, and they come in and say, wait, why couldn't they just do what we're doing and have a little bit of a freak out, that you have to have an answer for it. So we, our answer is kind of twofold. One, I'd say network and culture. Second, I'd say is data. So network and culture really quickly. We focused on making sure we brought domain expertise from both the industry, and Steve and Mark Cuban, who's an investor with us, actually touched on this yesterday as well. It's really important that you have folks who understand the product, even if it means bringing in people who have a little bit more gray hairs than the average engineer, because they have the relationships. They know the problems better than anyone else. And we've been able to do that on the real estate front with the people I'd mentioned before and the product engineering front. I was at Blackstone before, and I have friends at a lot of different real estate PE shops. And there's a cultural dynamic that's really challenging to kind of navigate, to bring together tech and real estate. I've had someone tell me the tech team actually at their firm had a different physical office and had to wear suits when they came by to the headquarters. So you can imagine how hard it is to build an innovative culture when there's that. So we think we've done a good job there. That's not an enduring moat, network or otherwise. Data is. And so we're very focused on building the world's largest proprietary set of asset-level data in the alternative space. Long term, there's a lot of interesting things you can do there. Predictive analytics, create your own structured products, recommendation engine for people's financial futures. That's more of the aspirational kind of moat or differentiator. Right now, we're running as quickly as we can on network, people, and culture.
For us, our moat is unit economics. So when I think about the 4 main unit costs in our business, you have cost of marketing, cost of operations, cost of credit, cost of capital. If I go in order from a cost of marketing perspective, the reason we're able to play at a fraction of peers in this space is because of a customer centricity. It's the philosophy that sits behind the way we build product. It's the 3 layers I referenced before that's actually delivered lower marketing costs. If I think of operations, we don't have branches. And in fact, we heavily leverage technology. When I say we run faster earlier, what I mean is we're able to do a lot in a short period of time in a way that is incomparable relative to peers. Third, when I think about low unit cost on credit, that has a lot to do with data and the mix of data and technology, the way we underwrite our consumers. We were able to reach AAA status from Moody's and DBRS within 6 securitizations, for example. And so our cost of credit is really low. And finally, on capital, we've been able to compress our capital costs significantly over time. So in the 5+ years we've been at national scale, we've cut our capital costs in about half. And that's in part driven by some of the success that we've found in both the securitization market and the institutional whole loan sale market. We've been able to decrease our cost of warehouse capital. We have about $750 million in warehouse capital from likes of Goldman and Barclays and Citi, ING, Bank of Montreal, et cetera. And so I think it's the intersection of unit economics, but also what allows you to drive really low unit economics is marketing know-how, data, and technology.
We just have one more question left, basically. So
I would just add one thing. I agree with everything that my colleague said, so I'll just try to add a little bit of different thought. I think that, one, trust, transparency, and this idea of empowerment is something that the institutions haven't really focused on. 2 is, I think that with regards to businesses like ours, you got to be a little bit crazy to think that you could achieve the things that we're all saying we want to achieve.
With any new company,
that plays
especially with us, it's sort of amplified.
And that plays on your culture point, which is, you started off with 2 people, 4 people, 10, now we're 80 people, and everybody in the office really thinks that we're going to be the largest digital wealth management platform in the world. And they believe that to their core. And I think that culture, that excitement, that drive, you don't find that as often, if ever, in major institutions.
At this stage in a lot of their life cycles, right? Because I think if you did go back to the early days, you'd see that, but it's tough to really
get so big.
Yeah.
And I think that just playing on where you spent a lot of time in unit economics is, the reality is we have the cheapest cost of distribution direct to consumer. And we don't see that relationship in the major banks. So they're using broker-dealers, they're using all different sorts of ways that are costly to try and distribute their product. And at the end of the day, all of us are using data and technology to distribute more efficiently, more effectively in real time. And we spoke about the demand that someone like YieldStreet has, and maybe you guys have that too. So I think that plays into a lot of where our real moats are.
All right, just one more question before we let you go. And you have to give it just a brief answer, maybe a word, a phrase. What does the future of Wall Street look like when we see this disintermediation finally really take hold? What does that look like, Ashley?
I think you see major compression in fees and a fundamental rethinking of the way you have to treat consumers in order to attract them and keep them.
Ryan?
Yeah, my word would be digitized. My sentences would be 10 years from now, more than half of the top financial institutions in the world will have .coms after their names.
If I went word and sentences, word, I'd say enlightened. That is to say, I think people are going through, particularly large financial institutions are going through an enlightenment right now, based on the success that they're seeing among many fintechs. And I think what the learnings from that enlightenment will enable for the ones who are more progressive is a different way to think about the customer, a different way to approach the customer, and a different way to build product for the customer.
My word would be simplified, and my sentence would be, I think that more product will be in the hands of the consumer and less control of Wall Street kind of gobbling up the best-in-class investments.
Well, big thank you to my panelists, and a thank you to everyone here. Thanks.
Thank you for
Thank you
having
for having us.